welcome to our second lesson. It's a topic for today is income statement. Now, what is an income statement? And what are the main features of an income statement? Now, as a business, I would say you have to know how the business is performing, right? You want to know the value of assets you have. You want to know the value of liabilities, the capital you have, profits that you make. And you can only know this information if you prepare an income statement. Now, what are the main features of an income statement? We have revenue. This is money that comes in when we make sales. Another important feature of an income statement is costs, right? And these are the expenses incurred in running business. Then we have gross profit, and this is the profit made after costs of goods sold are taken away from sales revenue. So, let's say gross profit is equals to sales revenue minus cost of goods sold. Alright? Then we get gross profit. Now, net profit, on the other hand, or what we call profit, is the profit made after taking away all expenses and overhead costs, right? Other expenses. We get the net profit. Now, I just want to show you how to calculate gross profit and the net profit. Here's a small example. So, you have a business and you are opening stock. It's equals to $20,000. Now, $20,000, this is your opening stock. This refers to the value of stock. Stock refers to the goods that the business sells. So this is what you start trading with. Let's say monthly. Your trading period is 1 month. So in January 1st, this is what you have. Then you do purchases. You buy more goods worth $140,000. Right? That is what you have bought. Then, closing stock. At the end of the month, you realize that you have goods worth $30,000 with you. Then, you sold these goods at $240. Alright? Then you have some expenses, some costs. Yeah, transport costs, electricity, you paid salaries, and so forth. And this one totals up to, let's say, $12,000. So how do you calculate gross profit and how do you calculate the net profit? Therefore, we have said gross profit is going to be sales minus costs of goods sold. Now, Sales is simply the selling price. This is the selling price. And the cost of goods sold, this is the buying price. Alright? And how do we get the cost of goods sold? So cost of goods sold will be equal to what? Opening stock. That will be opening stock plus purchases minus closing stock. Alright, whatever you started with, add what purchased in the intention of selling, subtract what you did not sell, that is the closing stock. You get the cost of goods sold. So, opening stock is $20,000. Then we had our purchases of $140,000. And we were remaining with $30,000. We did not sell $30,000. And that gives us $130. So that is what? The cost of goods sold. Therefore, gross profit is equals to sales, and sales is $240,000. 240,000 minus cost of goods sold, which is $130,000, which gives us $110,000. That is the gross profit. Then net profit. This is whatever remains after all expenses is equals to gross profit minus costs or expenses. And therefore, this will be $110,000 minus expenses. We said what? $12,000. This one gives us $98,000. That is the net profit. Alright? Then, retained profit is the net profit after taking away taxes and payments to owners, which is reinvested back into the business. So this is also called profit plowed back. You made a profit, right? You paid taxes. The owners took some money in form of dividends. Whatever remains is taken back into the business, is what is called retained profit. So let's look at the various types of profit. We have gross profit. We have said this is sales revenue minus cost of goods sold. Net profit is the gross profit minus overhead costs, which include things like wages, electricity, rent, marketing, transport, and so forth. Then retained profit is basically net profit minus tax and dividends. Now, income statements are very important in decision making in a business. If you have an income statement, you know how much profit the business makes. You know how much expenses the business incurs. This one is very important in a business. If a business is thinking to relocate a factory, right, they make a forecast income statement in both locations and pay. You have a business in Mombasa, you want to relocate it to, say, Malindi, right? You have to make an income statement forecast for Mombasa. Then you make another one for Malindi, then you compare. Balance sheet, right? This is a document that shows the value of the business, assets, liabilities at a point in time. In other words, balance sheet is a document that shows the financial position of a business as at any given time. If you prepare it weekly, then it shows you the value of the business in terms of the assets, liabilities, and capital as at the time prepared. So let's look at assets. These are items of value owned by business. For example, furniture, cash in hand, cash at the bank, buildings, machines, vehicles, and so on. Liabilities, on the other hand, these are debts owed by the business. When the business buys goods on credit, they have a debt, that is a liability. When the business goes to the bank and borrows a loan, that is liability. An overdraft facility, where the business is allowed to withdraw more money from the bank than they have, that is liability. There are two types of assets, right? Current assets and non-current, or what we call fixed assets, right? Current assets, these are the short-term assets, items owned by businesses for less than 1 year. For example, raw materials, cash, debtors, stock. Non-current assets, or what we call fixed assets or long-term assets, are items owned by the business for more than 1 year. For example, buildings, land, company cars. And that brings us to the end of our first part of the lesson.